Right, well, welcome to Crypto Monday Zoom. It's 29th of April. This is on global thought leadership. We have people from around the world who are blazing the trail in crypto, blockchain, AI. And so, yes, we have a guest speaker today. This is next week's guest speaker. Forthcoming attraction next Wednesday, Dylan Hunziker, Surmount Systems. It's all about quantum. So if you're excited, if you're into some controversy and or you find it nerve-wracking, please join us next week for that.
Yeah, I heard she was, I wasn't there, but she was the featured guest a couple weeks ago at Crypto Mondays in New York, Crypto Mondays Bitcoin, talking about, the quantum problem. And supposedly people said it was a great talk. So I'm looking forward to hearing her myself.
Brilliant, brilliant. Thanks, Lou. And then in terms of featured guests, just a reminder that we welcome recommendations. There's on the website, you can sign up and apply to be part of this program. We're looking at thought leadership. It's all about the personal journey, passions, trends, technologies. It's to stimulate thought and conversation. It's not just a one-way delivery. It's for engagement. We encourage that. And it's not for shilling. It's a purely educational opportunity. And it's in line with our helping our community to learn, earn, and connect. And then if there's anybody here who'd like to make an announcement, a product launch, capital raised, a new job, I believe somebody messaged me called Philip of Archesium, who said, "Oh, there we are, Phil. It's Phil. Okay, cool." So they've just secured a new deal. So
Yeah,
Phil, please jump in and let us know.
sure, sure. So
Uh,
we are Arcesium. We're actually part of the DE Shaw hedge fund. We're sort of the technology arm of them. It's basically a front to back, back office accounting system for hedge funds, institutional asset managers, prop shops. Been around 11 years, 2 years in the DeFi space. But yeah, we just announced that we closed the deal with Feynman Point Asset Management, which was formerly known as Republic. And they're using our platform for front to back as a unified platform for reconciling their TradFi and DeFi positions across multiple asset classes. So just want to say that.
that's
And
super cool, Phil. That's
yeah, yeah.
really awesome. And Republic's not, it's very well known. So yeah,
So.
that's great to hear.
And if anyone's going to be down in Miami next week, stop by. If you bump into me, say hi. Or if you like
Wonderful.
if you like smoking cigars, you'll probably see me smoking a cigar somewhere.
Nice. Love it. Thanks, Phil. Thanks
Okay.
for the
Thanks.
introduction and thank you for the invitation.
Thank you. Thank you.
Jeffrey,
Hi. First of all, thank you all for running these sessions. They're incredibly helpful. I am talking about a new job. I joined 3 months ago High Ridge Trust, which is a qualified custodian out of Nevada, Lou. And I just wanted to say we officially launched a month ago. I'm very excited. I'm going to try to take what I learn here and help it make me a better employee at High Ridge Trust.
that's absolutely
All right.
fantastic, Jeffrey. Thank you.
Very cool. Congrats.
Thank you.
Congratulations.
That's good to hear. Anybody else like to make an announcement? Going once, as Lou would say, going twice. Right. Let's carry on. Just we'll put this in the chat, but join Crypto Mondays. You could either scan the QR code or click on the link. I'll put it in the chat a little bit later. Waitlist for Agent Mondi. Alan Dumain, who's on this call, has been toiling, burning the midnight oil, building this Agent Mondi with his team of agent coders. And we're very soon going to be launching it. And so we'd love you to waitlist for it. Just go to cryptomondays.io and sign up for the waitlist there. We'd love to have you piloting it with us. And then these events are put on Crypto Mondays on Zoom. So if you'll join us on the Luma link, then you'll be notified of upcoming events. And then today's featured, well, before I go to Thailand, let me just, Lou often likes to say a couple of words. So Lou, is there anything that you'd like to just mention, updates from the Crypto Monday side of things?
Next week, Crypto Mondays, Miami, May the 4th. That'll be fun. And we're going to be also we have the chapter organizer meeting next week for the chapter heads around the world, and we're going to be rolling out the beta version of Monday, which is the community management AI agent that we've been building for a while. So that's an exciting time. Sign up for the beta at cryptomondays.io if you want to give it a try. And I'm excited for today's speaker. I've known Tyler for a few years now. We started off as friends. Tyler and Splyce ended up being part of our AI Web3 accelerator, the first cohort. They were great contributors, and it's been fun to watch the company continue to grow. And the DeFi has not been an easy space, but Splyce, I think, has really carved out a place for itself. And I'm excited to hear Tyler talk about his journey and where Splyce is at.
Great, thanks, Lou. And then just a little bit about Tyler. He's going to tell you more, I'm sure, but a co-founder and head of strategy at Splyce, on-chain credit platform with DeFi openness, institutional pioneer, a former head of digital assets at Securities and S&P Indices, and launched crypto ETFs and tokenized indexes. They were, I think, pioneers in that, but I'm sure he'll explain that a lot better. He's a frontier builder, over a decade of experience in designing the institutional rails used by global banks for tokenized fund structures. Multi-chain expert, Stellar, Solana, and Sui ecosystems. And without any more, here you go. Off you go, Tyler.
Awesome. Thank you.
Over to you.
Yeah, I was going to start off with my background, and then probably I'll do a little bit of a deep dive into Splyce, run you guys through a short deck of ours, show you guys a demo, and then happy to open it up for questions, tackling anything from tokenization, DeFi, credit, RWA, AI, whatever, is of most interest. All those things are definitely sort of speeding towards each other in a collaborative way. So I think it's a great thing to explore. So I know you guys got a high-end view of my background just now. I've been in crypto. I'll just beef out a little bit of that. So I've been in crypto quite a long time. Was just an econ nerd around like 2011, 2012 era, reading about the future of money systems worldwide. And pretty much every book I was reading alluded to the fact there'd be a new system, a new financial system, right, eventually. But they never really touched on, what that system would be. So, literally just sat down with a laptop and started researching, what could be next. This was when crypto was, very, very little known. So, found Bitcoin, obviously, pretty quick. I don't want to make it sound like I did a year of research, because it was actually quite a quick journey to find out what was next. And then, after finding Bitcoin, I actually got a chance to work with the Ripple team, beta testing the first DEX that was ever built. This was actually 4 years before the first Ethereum DEX. So working on that, it was integrated directly into the XRPL ledger. And, that really for me was, sort of the light shed moment for crypto. I mean, even back then we were doing instant swaps, instant trades, cross asset, just over my laptop with no barriers, and very, very little, if not, if any cost. So, having worked in finance, I was currently working in finance at that time, and, saw sort of these traditional bottlenecks, on a day-to-day basis. For me, that was, really the first revolutionary sort of inflection point. I continued to work, on the finance side during that time. I worked in asset management, and then I switched to S&P Indices. So that is the largest index provider in the world. They are the largest index provider for ETFs and for mutual funds. And specifically there, my focus was ETFs. At first, that focus was just all ETFs, working on global strategy, deciding what we would launch, where we would launch it, what the underlying exposures would be, things like this. But was always, sort of raising the crypto flag internally. And, finally, when we started to get clients call us in 2017 era, looking for crypto ETFs, the CCO pretty much gave me carte blanche to go build the digital asset team there. So this would have been the first digital asset team in the entire S&P organization. Looped in some of the people that are running it now there, in a different capacity. But this was, ground up build, right, for crypto ETFs. We did everything from investing in crypto data providers to, figuring out how to onboard that data, building the infrastructure to onboard that data, and then, started constructing crypto indexes and then licensing those indexes. So was really proud to, play a role in that first big wave of crypto ETFs. Did a few with 21 shares and some others. And then also I worked on the absolute first in the world quantitative crypto ETFs. So these were like risk buffered strategies that laid over Bitcoin and Ethereum single exposures. That was also with 21 shares. So that was like a first of its kind product. The first products that really went beyond just a single asset exposure at the time, with a risk buffer layer over it. Also got a chance to launch the first multi-asset ETF that was actually part Bitcoin, part S&P 500 with a firm called Cyber Hornets. Pretty cool product. Check it out there. I think it took us like 3 years to get it through the SEC. So lots of hard work on the Cyber Hornets team trying to get that done. Still, in my opinion, quite a revolutionary product compared to, what's out there in the ETF space. And then towards the end of that tenure, I got into tokenization. So I tokenized the first indexes. They didn't do that well, but that is a story for later that sort of dovetails into what I do now and what I've tried to do since then, which is really solve the tokenization flywheel problem. And these were major indexes. I think we tokenized the S&P 500 equal weight and then an AI-based index with Securities, actually. So, I'd been in the ETF space. A lot of the people who, were my mentors in that space were the ones who built it from essentially the ground up. Were there since the late 90s or so working on ETFs. And, they really imparted on me the transition from like mutual funds to ETFs, really just being a tech-based wrapper improvement. And it was really easy to draw the parallel out for tokenization from there, right? Like we saw what happened to mutual funds when ETFs went from end of day trading to intraday. We saw liquidity ballooning. Certain features like tax loss harvesting drove the numbers up even further. And now if you look at like inflows into mutual funds versus ETFs, it's pretty much one-to-one outflows on the mutual fund side to inflows on the ETF side. It's almost like that wrapper structure became, completely outdated for new entrants into the market. So really started focusing on tokenization then. Back at S&P, the idea was, okay, we want to, retain our market share that we have in the ETF and mutual fund space once this swaps over to tokenized structures. And, I left there in 2021. We were doing a lot of stuff. And, honestly, what you see them picking up and running with now after a few years of sort of transition, let's say, is really like the same stuff that we were, piloting back then. If you've seen their link ups with like Centrifuge or Denari, they've pushed into ratings. So, really happy to have been there from the beginning with that. After I left S&P, I joined one of the larger tokenization firms. So this would be a firm called Securrency. It was basically Securitize's rival at the time, both doing pretty much the same thing, primary securities tokenization. We had major investors like Abu Dhabi Catalyst Fund, State Street, Wisdom Tree, and some others. And we tokenized, I think, 13 of some of the first SEC registered tokenized funds, and actually helped work with the SEC to push that initial framework through, even though it was flawed and hopefully, in my opinion, gets updated. It was still, great to get a behind the scenes look at that. Securrency was sold in 2023, and that's basically when we spun out our team. Internally at Securrency, I've been running a team with a few other leaders at the business. I was head of digital assets. I was working with the head of engineering and the head of DeFi to essentially start solving the tokenization flywheel problem, meaning there was, a huge lack of utility and a huge lack of distribution for these assets. They were trapped in walled garden markets. So, you could hold them in a wallet. Maybe you could earn yield at that point, maybe not. but there was no real way to like drive velocity and put that asset to work the way you would in like traditional finance through, say, like repo markets or securities lending. So when DTCC came in, we actually spun out that entire team and bought the IP that we've been working on. And now we've made it a much more open, decentralized version of that original concept. But essentially, Splyce is what we started working on then to solve at least one area of this distribution and utility problem. And I think there's a lot of people across the space who are finally getting this message. But that's why I'm so bullish on RWA. For me, the writings on the wall, having come from places like Securities, where I did, huge projects with national banks, or even at a country level in some instances. And I'll give some examples. And this also ties into, why we built Splyce. But probably the best for understanding why tokenization and DeFi, will be ubiquitous is really cost savings at the end of the day. On the side of the issuer, and I'll explain that a bit. So we went into a tier 1 bank at that time, bank custodian. They offer all services, and the job was essentially to run a POC where we would repipe their entire securities lending business using a tokenization plus DeFi architecture. And we did that. We ran it through all the normal volumes they'd see throughout a year, and the estimated cost savings just from that one team moving to a tokenization architecture was over $1 billion a year. So that's when I say ubiquitous, that's like the sort of the insight that's guiding that opinion of mine. And I think you're going to see that pretty much across the board. That's why you're going to see, or that's why you are seeing people like BlackRock and others step in, because they can automate the entire fund management life cycle, and the cost savings are well into the 10 figures annually. So massive sort of not upheaval, but massive opportunity for traditional finance to sort of repipe their systems and become more efficient. So that use case I just went over with the tier 1 is essentially sort of like what birthed conceptually Splyce. And maybe now is a great time to bring up some slides and go into that. I'm also happy to, pause and take any questions or, comments on any of the background I gave.
Yeah, why don't you go into the slides?
Cool. Just give me a minute. All right. Can you guys see?
Yep.
Great. So what is Splyce? Splyce is essentially a fixed rate, fixed term institutional lending market. We are going to be bringing this to Solana, Stellar, at launch, Solana and Stellar. And then shortly after that, we're going to be bringing the full stack to SUI and then EVM. So pretty broad coverage. We're looking at all of those chains sort of holistically, in that, one chain offers, one great benefit, say institutional assets that aren't being used reside on Stellar. And then there's, maybe deep liquidity on the lending side, let's say on Solana. So, really trying to blend the best of all these networks together. And I gave you some background into why we built it. We saw firsthand, like I said, that there was, definitely going to be a demand from this, and RWA in general needed sort of a flywheel moment. So this is really meant to solve this distribution and utility problem, for tokenized assets. So on the utility side, essentially what that refers to is the fact that you can't use these assets for anything. Again, they were trapped in walled gardens, earning yield, but you couldn't put them to work to earn more money while keeping the original exposure. And then distribution, just simply no one had access. So when we started building, we basically took a look at DeFi lending in general. And this, predominantly is based off crypto lending, but, obviously that shifted a little bit. So we came up with, essentially 3 structural problems with DeFi lending. And, from the start, we built to address these. The first was going to be that both sides float. So that means essentially that borrowers are facing variable costs while lenders are facing variable yield. And then when you see a sentiment shift or a market downturn, lenders exit those markets. There's a lot of like non-sticky capital in those markets, which is not great for a business. And then on the institutional side, no one can really underwrite the trade, right? They can't do capital planning. And this is a huge barrier in terms of onboarding institutional capital, which I believe is really going to be the next wave that, pushes RWAs to the trillions of dollars. The next one should really not be a surprise to anyone, and that's Oracle risk. Anyone who's been, following X the past few months, it seems like there's a manipulation of oracles almost every day, leading to both theft and then artificial liquidations as well. So even when those are like working great, there's still very volatile oracle pricing that leads to cascading liquidations on certain platforms. So our entire structure was really built to eliminate the need for an oracle. And this is from a team that has built their own oracles that can stand up against any of the ones that are actually being marketed as an entire service. So very familiar with oracles, dropped them intentionally, not going to use it. And we did that through a structural process. Happy to dive into it later. And then the third one's really contagion or the systemic risk on some of these platforms. So the main problem you see in a lot of existing protocols or vault protocols is that the capital, like the actual collateral assets, are all pooled, right? So if you have one bad loan within that pool, and it blows up, you essentially see a rate impact across everyone, right? And the resounding feedback from institutional LPs we were talking to was this is not acceptable. And again, it goes back to that first point that they can't really do capital planning around rates that could blow up at any minute, right? So that's why Splyce became a fixed rate, fixed term protocol, really to address this type of issue. All right, so fixed rate, fixed term, isolated by design, all things I sort of hinted at on the last slide. And essentially, when you come to Splyce, when you open the DApp, you see one system and there's really just two entry points for people to utilize the protocol, one for borrowers and one for lenders. So for borrowers, they're essentially coming to Splyce to open a vault. They come to Splyce with a collateral asset. This could be a tokenized security. It could be a permissionless RWA, or it could even be crypto. And they can spin up their own vault around their own terms in about 30 seconds. And they have a choice over everything that they're putting out there, right? So they're choosing the collateral asset. They're choosing the APR that they want to pay to lenders. They're choosing the duration, the funding window, the TVL ratio against the collateral. They choose all this. So what we end up with is a system that works better for borrowers, specifically institutional borrowers, and a system that they should be seeing favorable rates compared to other platforms as well. So borrowers come for liquidity with collateral. They're essentially taking out a loan from the vault. They pledge that collateral into the vault, and who services or who funds that loan is essentially the lenders. So lenders are coming to the same vault, dual-sided structure on the vaults. So lenders enter one side and they're essentially coming for permissionless yield. So they deposit USDC either into splyceUSDC, which I'll touch on in a minute, or they deploy it directly into a named vault, which I'll give an example of later. And they get a rate locked at entry, right? So fixed rate, now capital planning can happen. There's no yield floating around. If a vault says they're getting paid 8% over the duration of the vault, then they're going to get 8% over the duration of the vault. If one borrower defaults, nothing else moves. Again, addressing that contagion issue that you see in other platforms. So I'll dive into splyceUSDC a little bit here. This is essentially our aggregate yield asset. So real yield automatically compounding. You simply deposit to the splyceUSDC vault and you receive back splyceUSDC. All of the yield auto compounds. There's no staking, no claiming, no lockups. And all of the yield within splyceUSDC is based on real world credit activity. It's not, token emissions and utilization curves and incentives. This is yield that does not compress, and it specifically does not compress when, say, DeFi or the crypto market is having a bad time in general. And I'll explain that maybe a little bit further. So, in general, when activity goes down on other platforms, you see rates compress, right? What we actually expect to see, is completely steady rates because our rates are fed by fixed term lending. But the other one is I actually expect that they would creep up a bit in a tight market because you have borrowers who are willing to incentivize more to get liquidity. They're in a greater need of liquidity during those times. So where you might see maybe the proxy is like syrup USDC, their yields start dropping under tightened markets. You'll actually see, well, even though we're a similar concept, structurally it functions much different and yields actually start to creep up. So splyceUSDC is positioned really as the distribution asset. It's positioned as the pristine collateral from Splyce. You can post it on lending markets or loop it or use it as margin and trade it on dexes. It's really a yield-bearing token that gives you multiple exposures and earns while you work across DeFi. What works in tandem with splyceUSDC are the single asset vaults, and you would have heard me describe this as a borrower vault earlier. And the way to think about this is simply you have single asset vaults at the basis with a bunch of borrowers setting up individual vaults, and then you have splyceUSDC that sits on top of it. So all of the fixed rates that are coming out in the form of yield from the single asset vaults flow up to splyceUSDC. And likewise, all of the stablecoin deposits into splyceUSDC flow down to the single asset vaults, filling the lending side. And it's really as easy as, the 3 steps up here. A borrower simply comes with collateral. They set their LTV, their rate and terms, and then the protocol creates an isolated, or what we call a single asset vault. So again, it will just be that collateral item in that vault to prevent liquidation cascades, intermediaries, and all of the things that have sort of been plaguing this industry and, essentially keeping institutional capital at bay. So once that vault is deployed, it's completely open, completely permissionless for stablecoin holders to enter. They simply deposit USDC during the collection window. They get a rate locked at the deposit, and they receive transferable vault tokens back. And they're getting a single asset exposure in this instant. And again, we'll run through an example of how that could look in just a few minutes. But the moral of the story is we're abstracting yield away from the underlying RWA assets, and we're able to pass this to lenders permissionlessly because it's based on a loan and not the asset itself. At settlement, all that happens is a borrower repays principal plus interest, the collateral gets released, and then lenders redeem. And that is the process. We're going to allow borrowers to actually auto roll vaults too. So if they have an open, say, money market fund vault and the duration is up, we have a lot of institutions wanting very short duration, think like 30 to 90 days type range with high yield. So they can either close that, open a new one with different terms, or they can auto roll the existing terms if they're getting a lot of liquidity and the market's accepting it really, really well. All right, so I'll play a short video. So basically what this is going to walk you through is what would happen when you come into Splyce as a permissionless lender. So this is someone coming with stable coins looking for yield. They'll essentially see a single asset vault marketplace. These are all the single asset vaults that are hosted on Splyce, and they'll be able to sort and filter and pick through the open vaults based on, what the collateral is, who the institutional vault sponsor is, what the APR is paying. We'll see on this one for a money market fund example that it's 8.75%. And they simply connect their wallet to the protocol and then deposit stable coins. So you'll notice during this live deposit, you'll see funding go from 62%, meaning the vault's not completely filled, all the way up to its 30 million capacity. At this moment, you would click deposit and approve. You would get back a vault share token that's completely tradable and transferable back into your self-custody wallet. So about 30 seconds, let's say, to permissionless yield. Oops. So why would an institutional borrower choose Splyce? And I mentioned being a capital barrier a few times, but what that really means is the need for institutions to know their cost of capital. So with variable rate DeFi resets, this makes it pretty much impossible for an institution to underwrite, say, a 30, 60, 90-day trade or longer against a rate that moves daily. So we fix everything at origination. That doesn't change. And it makes it creates a structure essentially that institutions can borrow in a plannable way against. There's going to be no midterm liquidation. So Oracle-driven protocols essentially terminate positions based on a price feed, not your credit. So if ETH drops 20% intraday, your position is gone. Our single asset vaults have no midterm oracles, no middleman oracles. So settlement simply happens at maturity. So you can think that instead of basing liquidations on price, we're actually basing liquidations on credit. So a margin call, not a liquidation cascade. And then also we're going to offer branded vaults to institutions. We've had quite good uptake actually on the borrower side for this. So these are actual institutions who want to work with vaults. They want, say, their brand name on a vault. So they're actually staking their institutional reputation as a part of the credit agreement, building a track record into DeFi, and hopefully over time attracting better rates and more lenders to their pool. So when I described it as a marketplace, it really is that. We want lenders to come and see a variety of options, and we want borrowers to basically be trying to put out the best terms to attract those permissionless users who are looking for yield. So every action earns strands. You can go to splyce.finance right now and sign up for the strands program. We've had quite a number of signups already. I think we're somewhere in the region of like 25K vetted folks. So these are people who actually kind of signed up, provided email addresses, and they're actually either referring and earning, they're boosting Splyce on socials, or they're depositing into splyceUSDC and earning. And these all work through boosting points, which we call strands, against the eventual token launch. So Splyce is set to launch in about a month, maybe a month and a half, but you're already able to come and start interacting with the protocol and getting a sense of things and start earning strands. So yeah, I gave you my background. Pretty much the entire team comes from an institutional pedigree. I won't belabor mine. Manuel, one of the other co-founders, is actually worked at the second largest index provider at the same time as me. That would have been MSCI as their head of MENA. And prior to that, built a $130 million sales team at Risk Metrics before they IPO'd. Anton, one of the earliest ZK Sync builders. Obviously, ZK Sync did 458 million when he was working there. He was the head of blockchain engineering at Securities, and a long time ago, he was a rocket scientist. And Ross, marketing guru, has driven over 65 million in raises for Web3 projects. He's run his own marketing shop. Came in super motivated. We added him as the CMO and co-founder in 2025, and has hit the ground running. But the focus here, you heard me speak a lot about institutions, and everyone on this page has built at the institutional side, and is familiar what those demands are. And I think that closes it up for terms of slides, but I'm happy to dive in and answer any questions you guys might have.
Thanks so much,
Okay.
Tyler. That was, wow, quite a mouthful. But Lou, you got to jump in?
Yeah, I
Sure.
did. I had to do a 5-minute earlier, so I had to expand it today. So I gave
Very
you the full
impressive.
version. Yeah.
Sorry, Lou, jump in. Go ahead.
No, so obviously, kind of you're launching the the two-sided market. Which side is more challenging, and how do you do that?
You know what? I've gone back and forth in thinking about which side is more challenging. But honestly, we're meeting demand that already exists on both sides. So I'm actually really, really not surprised, but the amount of borrower demand is quite huge. I mean, we're talking to facilities that have well over, say, like individually $1 billion in collateral on their books in the form of tokenized securities or permissionless RWAs, or even crypto assets that they're looking to deploy vaults for. So quite shocked about that, just how big it is. I mean, that's why we built it. We knew this demand would exist, but it's great to see them sort of like immediately stepping in. And this, ranges from anyone from like a foundation to a tier 1 trading firm. We're also integrating at a few large custodians and tokenization shops to essentially tap further into these sort of pools of capital that sit there. If you think of Splyce like a decentralized securities lending or repo market, it's easy to see that like usually those are housed within custodians. So obviously they're a huge target for us in terms of tapping borrowing capital. On the permissionless side, so users who are coming in and looking for yield, it's a little more opaque. We actually have a pretty good uptake in terms of initial LPs who want to come in and support this. Meaning they'll deposit initially into splyceUSDC, and then that will flow into the SAVs or come into the SAVs directly. And this like really spans the gamut, man. This could be an LP fund that has, a wide mandate, could be a liquid fund. In some instances, we're talking to tier one trading firms who also want to fill the lending side because they can get short duration, high yield. So think like a trading shop wants short duration, high yield, they can park there or roll to a new vault. And as of yesterday, I mean, we're even talking to Bitcoin holders. Like Bitcoin hasn't had a lot of, sort of yield generation potential. There's been a couple people trying to hack that together, but it hasn't really come into fruition. So as of last week, we're talking to a group of $2 billion in Bitcoin, assets under management who's specifically looking for permissionless yield. So, really we're just trying to pair people like that along with the broader, retail and institutional markets who will come in through, various avenues with the borrow side. But the capacity on the borrower side needs to grow. And like this, I mentioned to you at Mondays like a week ago, right? Like success is measured in the trillions, in this type of thing. And, we're still a little ways off.
Wow. Your mic, Lou.
What do you think is the, as you think about it, you're going to get out there, then what do you think will be the gating factor to growth?
The gating factor to growth. So we, as you know, for sure, Lou, we've been building vaults for quite a while. And I got to tell you, like when I was building vaults, maybe we started a year and a half ago, no one even knew what I was talking about. And, we pursued, there's a lot of things you can do with vaults. I'm happy to run over what other use cases we've built already that I think will be interesting down the line. But we essentially tore down Splyce, towards the end of last year to rebuild it into the Splyce I just, demonstrated for you. And we did that to really remove what I thought was the biggest gatekeeping item, which was under our previous model, we really depended on onboarding specific clients, which means you're basically running like a TradFi shop. So under this new tweak, it's much more open. We let institutions instantly deploy vaults and do it completely on their own. So we don't have to focus on scaling through like a traditional sales team. But that was the biggest gatekeeping item. Obviously, I think that, I don't expect really gatekeeping items under the new platform, but obviously finding borrowers to match lender demand is the biggest task at hand, I'll say.
Oh, makes sense. Thanks a lot. Thanks, Robin.
Thanks, Lou. Vitaly.
Yeah. Thank you, Tyler. First of all, I would like to kindly ask you to accept my LinkedIn request.
Yeah, of course. Sorry, I don't check LinkedIn that often, but I'm happy to accept.
Yeah, because I might have many questions.
Okay.
And not enough space within this meetup. So my first question is, what kind of RWAs will be accepted as a collateral?
So we're really only focused on, and this is really the only type of sort of initial vetting we do, is making sure the proper institutions are coming on as borrowers. The assets that we've seen the most interest in are obviously treasuries. And this is, a TradFi product that's traditionally very heavily used as collateral in repo markets. So we're seeing that sort of same trend here, talking to a lot of big entities that hold a lot of treasuries on their books. We're also talking to, people with higher yielding assets, let's say in the 8 to 10% range coming from private credit. And then, really any yield bearing asset within that is sort of the key focus now. But obviously treasuries is outpacing, the other ones. Essentially you're able to hold, let's say 4 to 5% money market fund, take out liquidity and fund more earning potential on top of that. And the great thing about using a yield bearing RWA as collateral is it offsets the rate that you're giving to lenders. So the lender's getting a permissionless yield that's based off the borrower rate the borrower sets. And in many instances, we can see them offset that near 1-to-1 or at least by half on a high yield offer. So it's really made to work in that way. And then they get liquidity and they can go earn more money, whether that's deploying into a different Splyce vault at a higher yield or conducting additional, trading behaviors, whatever they want, really.
Yeah, got it. Thank you. Basically, tokenized T-bonds, right?
Yeah, exactly. So T-bills, money market funds, those are definitely seeing the most demand. Private credit definitely deserves a shout out just because the yield profile is very interesting to DeFi, and there's a lot of them up. We do plan to move into single stocks and equities as well in the future. Just waiting for those markets to become a little bit more robust.
Yeah, that was my second question because again, now it looks like that there is a market for that because yeah, you can buy tokenized Apple, for example, but you cannot borrow against tokenized Apple because mostly those securities, either tokenized by securitize or X stocks, they're permissioned. That's why you cannot just delegate them as a collateral. But again, some securities are permissionless, just the ordinary ERC-20 standard, so they can be used as a collateral. And probably this will be the subject of a separate conversation if you accept my LinkedIn.
Yeah, 100%. You said some interesting stuff, and we actually we sort this already. So the plan is to offer this service both for unpermissioned RWAs as well as securities tokens. So some of the people you mentioned, we are working with them to make this available for securities tokens. And there's a few ways we make that happen. The main way is when you're setting up a vault. If it's a securities token, you essentially have to choose to use a designated liquidator, which means a KYC liquidator. That's an institution that would come in, buy the bad debt, and then sell off those assets and return money to the permissionless lenders. If you're doing an unpermissioned asset, you don't have to choose designated liquidation. You can just liquidate directly to lenders. So it works much, traditional lending on the crypto side would. But yeah, that is a big hurdle. We've made it pretty simple. You literally just have to whitelist our smart contract address at the issuer level. So once that happens, they're able to deploy securities to a vault because the ownership is never changing hands. It's all self-custody, and through a designated liquidator, if it does have to change hands, it's a KYC party. Meanwhile, the experience for the unpermissioned user looking for yield is completely uninterrupted.
Okay, got it. If I'm not mistaken, now when the collateral takeover happens, basically this is not on the depositor side. They are not taking over this collateral. They are not. They don't have the need to go to the secondary market and to sell it. This is not like on Aave, right?
Yeah, it's structurally going to be a bit different, right? Like they're coming with their collateral. The only time the collateral would leave their hands essentially is if there was a liquidation event. But what we've done with liquidations essentially, like I mentioned, we took out oracles, so it's not price based, it's credit based, meaning we don't expect to see liquidations really at all, especially from the cohort of institutions that we're onboarding on the borrower side now. That's also another reason we wanted to go with like branded vaults that actually put the reputational risk behind some of these products.
But again, if in the case of non-repayment, what will be the collateral flow?
Got you.
Yeah, how the collateral is supposed to be sold? Is it the secondary market?
No. So the collateral is pledged to a vault at the maturity of the vault, which is essentially the maturity of a loan. The borrower simply pays back that cost of capital. So it would be paying back in stable coins, the principal and the interest. The interest is essentially the permissionless yield that flows to the permissionless lenders, and their collateral is unlocked and sent back to their self-custody wallet.
Okay, got it.
So
sorry for utilizing.
Yeah, no, I love answering these questions.
Yeah, so sorry for utilizing the time of the audience. Maybe I will contact you through the LinkedIn, and we'll just set up a 20 minutes call to.
Sounds great, man.
Thank you, Vitaly.
Thank you.
Ali, over to you.
Thank you so much. It's been a pleasure actually being part of the Crypto Mondays.
Thanks, dude.
Myself, Tyler, and the rest of the people here in the group, my name is Ali. I have been involved and just stepping into the fintech after getting involved at the art world. This is where my questions will be coming from, Tyler. So the art itself, can it be considered as a collateral? Let's start with that.
So, super interesting question, actually. And I think if you asked me maybe a year ago, I would say no. And the main reason I would say no is because liquidations need to occur, and liquidations have traditionally always occurred through pricing, of which art doesn't really price frequently enough to do this. Under Splyce's fixed rate fixed term setup, I see art becoming a viable collateral for sure. I'm not going to say it's our focus right now, but I could definitely see it having a place within this type of liquidationless lending setup.
Tyler, I'm currently working on a marketplace where I segregated the wallet foundation that we started with a US bank who offered to basically just the custodial while we were just simply we're trying to integrate the hybrid custody, hybrid escrow solutions for the products that we list in an immersive areas. So we do have the marketplace that we do send our intake forms to be able to base the KYC and KYB, these galleries or the other institutions, which actually includes the auction houses and some of the family offices or people that are actually hold or collect art in the institutional level. So where we needed to create an escrow, hybrid escrow. So we needed to work out with a custodial partner. So they offered us to build our own wallets in the back end. And they basically verify everything. We just need to call the APIs whenever the transaction that was happening. So what we're actually in the process of creating the infrastructure for is an digital art custody and funding, where we are going to serve as a financial asset management layer for a broader ecosystem, where because we have a framework created that will be offered to the galleries as well as the other collectors around the world, which it's quite similar that what you are doing. And actually, the name of the marketplace is called Galata Vault. So we basically simply address all your earnings and under management and portfolio, or basically what you list, and it's verified to be on chain. So what we do is on and off chain solutions for the art assets, which simply a documentation of the cultural assets, which can even refer to the museums. So my second question will be based on what you answered. I will be asking another, just telling another topic, very brief. So in the event to get into this to work with the museums, would your company or you be considered as the liquidity provider if I happen to work with an asset that is sitting in the museum that
Yeah.
who allow me to basically give the all rights, which it's not being sold, would just basically be doing the SPV through a Wyoming entity, and that's where we're actually creating a subsidiary account under our
Yeah.
wallet, which is simply an orchestrated by the third party custodial American bank. And that's simply what we intend to do. And I wonder if there's any alignment and if you guys can help, because my agent, I actually been building the agent for the past 2 years.
So is there a question?
Thank you. So the question is your consideration to become an liquidity provider if I happen to work with a museum, just to keep that art in there and then create the fractions,
Okay.
then
I think he's
partner
got
with
it.
logic.
Yeah, we essentially would be, I don't want to say we'd be like an LP, we would be a protocol that you could tap into to get liquidity against the art, which is the collateral. Obviously, we'd have to do due diligence on that side. Essentially, we'd have to know who the borrower is and assess whether or not the credit profile of the borrower is worthy. If you got banks, involved, I think that's a good start. I can show you my newest art piece if you want, man.
Please, yeah.
Yeah, Lord of the Rings original.
Oh, wow.
Yeah. Sorry.
That's super cool. Okay.
Yeah. Ping me on
Tyler,
the side, man. Happy to chat about it.
Okay, cool.
Definitely. I'll be very interested in learning more because we're in the process of either doing the USDG or the base to create the contracts, and then we'll be actually pursuing the L2 of one of these just to be more, authentic in the US base, just because we're a US based company. So Tyler, I'll be adding you in LinkedIn, and thank you very much for the rest of the people here.
Love it, man.
Thank you, Ali. That's great. Gia, over to you.
Thank you very much. Great presentation, Tyler. Two questions. First, you mentioned that you don't use an oracle, but there seems to be also a liquidation action.
Yeah.
So how do you go about that? And the second question is, do you have any guidance for the users on how to set their interest rates? So for example, the lenders, how should they change their interest rate over time?
Yeah, definitely. So the first one is essentially like we knew oracles, have long been an issue. So we tried to remove it completely from the process. So essentially, what you're gauging is more not price-based liquidation, but actual liquidation based on the creditworthiness of the institutional borrower. And because we're targeting institutions, we're taking basically the largest initial step to ensure that we have creditworthy people on the platform on the borrower side, right? Like we're not completely opening up the borrower side to anyone. Could that happen in the future? Potentially. And then liquidation really is based off one question or not. And that is, did the institutional borrower repay this loan at the maturity date? If they don't repay the loan, then the assets are liquidated. So we take the collateral if the loan is not paid back, and then that collateral is sold and flowed to the lenders. That either happens directly if it's a permissionless asset, or it happens through a designated liquidator if it's a permissioned asset. So you asked me about rate guidance. The best example, or one of the examples I use when I'm talking to some institutional borrowers, let's say they have a money market fund that's doing 5%. If they put up a money market fund for 5%, they take out, maybe 75% of that. They set the LTV ratio to 75%. Now they've got a liquid, 75% of that total collateral value. And if they offer, a 5% permissionless yield to users, they essentially offset their borrow cost 1-to-1, right? So it creates a much fatter spread. And if they're trying to incentivize more liquidity sooner, right, which is often going to be the case, I think 1-to-1 is probably the starting range. And I think we'll see yields quite a bit higher than that, because an institution is going to have an actual need to put this capital to work. So they're going to want capital to flow in quickly, which essentially means incentivizing lenders to come in at a higher yield rate. So I would expect yields really to be in like the 5 to 9% range. Probably skewing towards the higher side of that. And again, in like a tight market conditions where liquidity is at a premium, rates will shift up instead of sort of tracking down and getting compressed like we typically see in DeFi.
All right, thanks a lot.
Yeah, thanks, man.
Thank you. I have a question, Tyler. It's not related to the product, it's more to you. Because, we went through the accelerator together, and it was super interesting, the resilience of the entrepreneurs, and you've always been very confident. And yet I think, and I see in the room, there's some entrepreneurs and VCs here. And I just wanted to know, like, what was that experience? How did you just keep going, and how did you reframe it? And, your resilience, your pivoting, your, just maintaining your confidence. How did you do that? What was that journey like?
I guess like the underlying reason is like I was exposed to tokenization in probably like 2018. I told some stories around that. And, really since that moment, I've believed in the space. And look, I've had to be resilient through sort of a lot of stages, just not at Splyce, right? Like I mentioned, the first tokenized indexes we did, I think we only took like 5 million in through Securitize's private marketplace, which I would not call a success because I was used to dealing in, tens of billions with an ETF launch. So, that was maybe challenge one. But, what kept me, let's say going through the founder journey on Splyce was, I believed in it, but there are proxies in traditional capital markets for what we're doing. we were with a tier one trading firm, and they, one of them called us a better solution than Morpho. One of them, connected the dots, was like, oh, this is decentralized repo market. So it's always good to like take small grains of feedback, that you're on the right path. But, nothing's really going to supplant the fact that as a founder, you're building, on a dark path, and you're hoping at the end of that path, you chose the right one. I think this really started exploding around DOS in New York a couple weeks ago. But, obviously we started building towards fixed rate, fixed terms, catering to institutional borrowers, many months ago. And that's like become one of the hottest topics in the space. So finally, yes, did get, vindication for all of, that staying the course. But yeah, it's a fun process. I don't think you can get me to trade it for, a desk job.
Brilliant. Well, thanks very much. Thank you to everybody. It's been absolutely fabulous. Thanks so much for giving us your time and your thought leadership for everybody in the room. It's just been absolutely awesome. And we wish you unbelievable success in your venture. It sounds like you've really got your head around it. That'll be great.
Thanks, everyone.
Thanks, everyone. Have a wonderful rest of the day.
Thank you so much.
Much appreciated.
Thank you.
Ciao.
Bye, guys.